Hello, and welcome to Trading Without Fear. Hello, and welcome to Trading Without Fear. This is part 2 of systematic trading and why you should follow a mechanical approach. Before I begin, I would like to say I'm not a financial advisor. Trading is risky, and this video is meant for educational purposes only. The objective of this episode is to help you get the most out of your data. The number one rule of mechanical trading system is having your entry and exit rules being precise. The one way to achieve this is by trading with an edge. Mark Douglas calls an edge a higher probability of one thing happening over another. The second rule of mechanical trading is trading in sample sets. I prefer 20 to 25 trades. Remember, mechanical trading systems do not use any outside source of information such as news, fundamentals, or your trader speculation. Nearly all mechanical systems are based on technical chart analysis or chart patterns. The advantage of using technical chart patterns over news, fundamentals, or even trader speculation is that technical patterns can be quantified. Mechanical trading systems can be used in any markets: options, OTCs, Forex, cryptos, and so on. Now let's look at some data sheets from a real trader. This data sheet was provided to me by a trader buddy of mine, and many trader data sheets look very similar to this one. I remember when I first started tracking my data, it looked very similar to this. I had the things like tickers, dates, notes, entries, exits, and etc. Even with me collecting all that data, it did not help me become more consistent in trading. If your data sheet looks a lot like this, ask yourself, how does it make you become more consistent? Leave a comment below. I'd love to know how other traders are using their data. What I notice in myself and others is that when you're doing something and seemingly without benefit, over time you stop. You may even begin falling into this category yourself. Like many traders, I collected data night after night because I saw some video lesson or online educators say that it will help me in my trading. Does this sound familiar? I would collect data for months and even years. My trading was unchanged. I would experience a series of winning trades and thought that I knew what I was doing. But then I would give back all or most of my profits back to the market later on. But why does this happen? A few years later, I figured out why this was happening. The reason why my trading was random was that my set of variables or reasons why I entered into the trade would change. These reasons could be what I thought was working or what I thought could happen. Sometimes I'd be right, but more often than not, I was dead wrong. Do you remember on the first video that Hadi said in part 1 of this series that he thinks that something is going to happen, he's usually wrong? If you don't remember that or you haven't seen part 1 of this series, I suggest you go back and watch that episode. I'll put the link below. So the reason why most traders start collecting data is because they either heard about it from an online educator or maybe they even read it in a book somewhere. But they don't really understand the purpose of the data collection. So let's think for a moment, what is the purpose of tracking data? Well, this totally depends on what you're trying to achieve. The information you're collecting should have a purpose as to why you are tracking it. Like most traders, my Excel spreadsheet looked like this. If your data looks like this, then ask yourself, what am I trying to get out of this and how is it helping with my trading? When collecting data, you first need to ask a question. What are you looking for to get out of this data? An example question could be, how do you know what your A+ setup is? When you're tracking your data, you first have to have a defined definition of what you're trying to find. For instance, if we're using the example as what is my A+ setup, we have to define what we're looking for of what an A+ setup is. So what I'm looking for is a clear pattern that forms often in the market with an average possible gain of 20%. That is what we're going to define as our A+ setup. That's a great start. Now let's have a defined criteria as what we're looking for. So step 1 of this process. If you are like most traders, you will have a wide variety of patterns, setups, and even reasons why you want to take the trade. What you want to do now is categorize them and give them names based on technical chart patterns. Now remember, the reason why we use technical patterns is because they are easy to measure. Now you don't have to know the actual technical chart pattern's name or anything like that. You can give it a name specific to yourself as long as you know what that pattern is and how to identify it in the market. Mechanical trading tells you what works and what doesn't. The only way to know this is to fully and detail track what you call a setup and eliminate any negative variable that is costing you money. If your goal is consistency, that means anything that is random is not consistent and you should not be part of your trading. Step 2. How do you know how often your edge shows up in the market? This is where categorizing them and giving them names comes into play. You can write a simple code to count the names of the patterns and give them a number representing how often that pattern or setup appears and works in the market. By doing this, it will show you if you're trading the best possible trades with the highest probabilities in your favor. This method would show you what trades to avoid. If you're noticing that you're taking trades that shows up less and have a low probability of working, you can switch your focus to patterns that are working. Step 3, profit targets. In the example we used before, we were looking for an average profit target of 20%. But how do we know where the stock is going to go? In reality, there is no way to know what stock is going to be a winner or a loser, nor is there any way to know the exact top or bottom of any range. However, patterns that repeat have a high probability of behaving in a very similar way. Think of an edge more as an educated guess. Using past history and data, we can have a clear understanding of what is possible from that pattern. You would start by gathering data based on that particular pattern. You want to know where you would be buying the stock based on that pattern and a good risk level. Don't track wishes. Although many traders look at a chart and say, if only I bought at this level. Be realistic when it comes to tracking your data, both entries and exits. This is based on your trading edge, and it does not matter if you're swing trading, scalping, intraday swing trading, and so on. The more precise you are with and the more realistic you are with the data, the more realistic your goals will be. The markets flow. One month your A plus setup could be a morning panic, or the next month it could be a breakout. The month after that, a gap and crap. If set up properly, your data will show you when your edge is diminishing or has the ability to take more of the market. To accomplish this, collecting data on a month-by-month basis and not having one master data sheet with everything just thrown in it. As the market changes, what is possible from the market will also change. Your data will dynamically change along with the market as long as you do the work to input the required information and set it up on a month-to-month basis. Think of the information you gather as input, but where is your output? The output is the most important part of data collection. It tells you the answers to the questions you were asking. Remember, the data you collect should have a purpose. If you think about it like this, based on our example from before, we want to know what pattern would offer an average of a 20% gain. By having a data sheet that looks like this, where's your output? As your data starts to evolve, do you even understand what the data is telling you? One of the most common mistakes is asking the wrong questions to find the answers. If you're looking for a percent or dollar move from a pattern, what criteria do you need to track in order for that data to be accurate? Always remember, you need to have a rigid set of variables to define your edge. I've been helping a trader lately develop an edge in the pre-market gap to ABCD pattern. I'll be using this as an example of identifying some key data to collect. Some of the data that we came up with for this pattern is, number one, how much did it gap? So what we did is we tracked the gap from the previous day's close to the current day's open. By tracking the gap percentage, this gives us a range of how far of a gap is too far, and it now has a greater chance of failing, and how little of a gap is too little for less likelihood of it reaching our desired sell target. The goal is to find the sweet spot where the odds are in our favor. The next step is we track the pre-market volume. We want to know if there's unusual pre-market volume to determine if the stock is running on air or if there is real buyers holding it up. Next, is the pattern clean? Is there a clear risk level to work off of? The next step is we'll take a screenshot of every pattern that fits our criteria, and we save them. This is called a trader's playbook. This is where you can look back and see what patterns worked. These screenshots will have notes for entries, exits, and any other notes about the trade. And it's a good idea to do it whether or not you traded that stock or not. If it fits your criteria, you want to notate it and put it in your trader's playbook for future reference. For outputs, you want to have the data displayed in any fashion you understand. This could be using pie charts, percentages, bar charts, or any other visual output. So to recap this video, first you want to start with a question. What do you want to achieve and what do you want to know? Second, you need to think of what you need to collect or gather to get the answer to that question. And then step 3, you want to have an output. What you need is to have some way to understand what the data is telling you. Over time, your data will become more accurate, and your inputs and outputs will change based on the questions you need answered. You can make data gathering as simple or as complex as you want, as long as you understand it. So the chart that we're looking at here is GFAI. It's March 11, 2022. This is what I would consider a gap up to pre-market ABCD pattern. So you can see here, there's this nice clean run up from yesterday's close. This little red dotted line down here is the previous day's close. Pulls back, consolidates, bounces off of this area right here, starts to reclaim VWAP. So this right here is what I would consider a clean, kind of a pattern that I'd be looking to trade off of. What I'd be looking to do is trade when it's above VWAP. When it's below VWAP, it just tells me there's sellers in control. So once it starts to reclaim VWAP, anywhere within this area is where I'd be looking to buy into. Traditionally, I'll be waiting to buy a little bit closer to open. My time frame, market opens at 7:30. So buying a half hour or so before market open is absolutely fine. So I'd be looking to enter into this trade around like 86 cents. So what I'd do is I'd click on it. If you're using Thinkorswim or another platform, there's some sort of measurement tool of where you can click on a part of the chart and drag it, and it tells you, what the percent gain or loss is. And so this right here says it's a, 51.57%. Now the reason why I'm going to $1.30 is where it kind of stopped right here, then it also broke through. So in this area right here, whether or not you want to go for exactly $1.30 or slightly down below, it doesn't really matter as long as you're getting the full range of the actual move itself. Now, if you're interested in learning, maybe you're in a position of where you're trying to learn, identify a new pattern, but you're having a difficult time with your risk. Maybe you're getting stopped out too early, or maybe you're taking too big of losses. Mechanical trading also shows you a way to actually figure out what your average risk should be per pattern. So in the same instance, if I was going to be, entering the trade at 68 cents, if my risk is going to be down below here, these candles, then my risk would be around 5% or 5.5%. So 5.5% risk for potential of a 50% upside. It's not bad risk reward. Some people may want to enter into it and give a little bit more wiggle room. So down to below this green candle down there, which is around 10.5%. Either way, as long as the risk reward parameters are what you're looking for, risking 10% for the potential of a 50% move is still not bad, as long as the data warrants that. So that's basically how I'd be getting the risk parameters for that. Now we pulled the data. So this right here is my data sheet. We'll be working off of January. So if we're looking over here with the Excel spreadsheet, you can see here I started tracking the percent risk. This is, again, just for purposes of this video. So what you want to be doing is tracking the risk. Per chart, you'd be identifying the places where you want to buy into and the places where the chart has a higher probability of failure, and you just put that down. Then you can write a code basically telling you what the average of that is, and the average will tell you, what your set risk could be. Now, there are some market conditions of where you might get into the same pattern, and maybe it's a choppier market, kind of like what it has been lately, and having a 5% risk may chop you out, and the stock may go in your favor. And if you're tracking that, it may say, instead of a 5% risk, maybe you need to give it a 7% risk or a 10% risk, and that way you can stay in the trade longer, as long as, again, the target profits are within the parameters that you're looking for. If you're trying to maximize the full position of the move, and you're only aiming for, let's say, a 10% profit target, giving a 10% risk isn't really, that great. It's a 1-to-1 risk reward. But if you're aiming for, a 10% risk with a 50% or even a 30% type of a profit target, that's still pretty good. It's either 3-to-1 or 4-to-1, just depends on what you're kind of getting out of your pattern. Another thing is a lot of traders, when they're trying to get into new patterns and new trading styles, they may end up having their risk too tight or too wide, so that you'd be taking small losses more frequently when they can actually be staying in the trade longer, and they just have to have their risk parameters set up. So one of the ways to actually identify that is to have something there, especially when you're trying to track a specific pattern or you're identifying a new pattern. You can actually see whether or not that you got stopped out and it continued going into your favor, which is why I have, did you get stopped out and did it reverse? If you're seeing a lot of those, it could mean that your risk parameters are too tight. You need to give it a little bit more wiggle room. Or in other instances, it could mean that you're buying too early or too late. So for instance, in this chart right here, as it's starting to ramp up and pulls back and it starts to ramp up again, some people might see that as a pattern that they want to get into. And so they buy it in right here at 89 cents, and they're risking, even 5% or even 10%, and then they get getting stopped out early because they didn't get enough time for the pattern to fully form. This part of it would actually give you an understanding whether or not you're getting in too early or too late. Another example of getting in too late is, let's say you're seeing this pattern again, and it's starting to ramp up, and you see it start to break out of this key level right here, and so you end up chasing it and buying it right here with the, let's say, a risk parameters of 5%, and it starts to come back down and gets you stopped out right before market opens and right before the trade actually works. So having that type of data will help you identify what your risk could be based off of each pattern in each trade. So next is trading in sample sets of 20 to 25 trades. Now, when you're using a mechanical trading system or systematic trading system, data is key. What I find is, instead of just using the data of the stocks that you trade, is using all the data from the stocks that meet your criteria. So hypothetically, if you trade ABCD patterns, and what I consider an ABCD pattern, what you consider an ABCD pattern may be vastly different. But when you're tracking that information, if you only track the stocks that you trade, you're limited to a certain amount of samples per day or per week. But if you're actually tracking everything that's in the market that fits your criteria, you may have some days that there may be 3 or 4 or 15. It just depends on the market conditions. You can see, like, for instance, on the January 3rd, there was 4 ABCD patterns that worked on that day. But if you're only tracking one that you traded, maybe CELZ, so for instance, on the January 3rd, there was 3 ABCD patterns that formed on that day. If you're only tracking GNPX, you're limited to that one as a sample size, and you're missing 2 that could potentially add to your data or make your data more accurate. So I do recommend, when you're doing a systematic trading or you're trying to collect your data, to collect all the data from the market on that day that meets your criteria. And when you're trading the 20 to 25 sample sets, each one of these is going to count towards that sample set. And at the end of the sample set, what you're going to be doing is reviewing the results at the end of that. So let's say if you're aiming for, let's say, a 15% profit target, and you're noticing that your edges have as an average probability of going up to 20 or even 25, it means that you can actually increase your profit potential. On the flip side, let's say if you're aiming for a 20 or even 30% profit target, but your edge is saying that there's an average probability of only 15, then you can actually lower your profit potential. And as the market changes, the data will change along with it, especially if you're actually setting up in parameters like this, where it actually has monthly data versus a whole master data sheet. So one of the questions that we had video was basically, what type of pattern is going to provide us with a 20% average profit target, and how do we identify an A+ setup? So using the information down here, it doesn't tell you what the A+ setup is. It also doesn't really tell you or give you an understanding of what the profit potential is from the specific patterns. So how do we actually get that information? So what we use is output. So we need to find some way to actually gather the information and present it in a way that's easy to understand. So this right here is how we're going to identify what our A+ setup is going to be in the market. So basically all this is doing is it's going to be counting all this criteria down here, which is the categorizing of the patterns, and it's going to count how many times you tracked them in the market for that particular month. So in this case, the ABCD pattern formed and worked 51 times out of the whole month. The breakouts only formed and worked 16 times. The first green day either didn't form or at least didn't meet my criteria, so there was 0. The gap and trap reversals only formed and worked 5 times, and the ABCD longs only 8. Now, the ABCD longs and the ABCD patterns are different. The ABCD long is more of a swing trade where it forms over multiple days or even weeks. The ABCD is an intraday swing trade that I do on the intraday time frame. So based off that information, that means that the ABCD pattern would be my A+ setup. It forms more often in the market, and it has a high chance of actually working out. So let's say in the instance of where you're focusing on breakout plays, and you're focusing breakouts in January, and what you identify as a breakout, when I identify as a breakout, may be vastly different as well. So if you're focusing on breakouts and you're noticing that you're having more losses, if you're not recognizing that another pattern that you could be trading is actually having a higher chance of winning, such as an ABCD pattern in this case, your focus is going to be in the wrong area, which is why you're going to be taking more losses than gains. In this way, you can actually switch your focus back over to the patterns that are working in the current market versus patterns that don't. Another way of visualization with this is just using a bar chart. So this bar chart basically is the same information. It just tells me what is the pattern that's currently working at this moment and this month and this current market. So how do you know what your profit targets are going to be? So in my belief, all of the patterns that form the market, because it's based off of human psychology, will have a statistical and repeatable pattern, will also have a repeatable outcome to that pattern. Again, depends on what the market conditions are, because it is human psychology. Sometimes if there's more fear or greed, they're going to react or act in a different way. So the way that we get that is through the data. Now, to clarify, the difference between a single and a home run is a single is basically the average probability of that particular pattern at that particular time. So if we go to this part of the output, we can see that ABCD listed patterns during January only had a 74% probability of reaching a 10% profit. So that doesn't really meet our criteria in this particular time, which also could mean that the markets are a little bit slower. So instead of having your expectations being high, you can actually reduce them down and take a 10% profit with maybe reduced risk of 5% or even 3% on each trade, just have tight risk. Then there's a 58% chance of only having a 15% profit. So those profit targets are still good, but it just tells you that overall, if you're aiming for too high in this market, you're not going to be getting what you're wanting, or you're going to oftentimes get stopped at too early because you're waiting for a higher probability. Now, conversely, if we jump to March, this data is only tracking ABCD patterns because from January, that was the A+ setup during January's timeframe. So for this month, for the purposes of this video, I only tracked ABCD patterns. So during this time frame, ABCD patterns formed and worked 63 times out of the entire month. And what it does, if we go up to the output for the profit targets, is it tells us there's a 100% chance in this current market in March to get a 10% gain. There's also a 100% chance of getting a 15% gain. So basically, you can aim for either one of those levels. And as long as you're in an ABCD pattern, again, what you consider an ABCD pattern, what I consider an ABCD pattern may be different. But at least you have a really high probability of at least reaching those numbers. The 20% gain is what we're looking for, was a pattern that would actually repeat itself frequently in the market and give us an average of a 20% gain. So the ABCD pattern has an 88% chance in March to actually reach that profit target of 20%. One of the things to note is as you start to desire more or want more percent gains from the market, you can see the numbers are actually dropping down. And that tells you that the more you're trying to aim for, so if you're trying to go for a 30% gain, to me that would be a home run type of a win, because you're wanting more than what the average probabilities are from the actual market based on the data that you've collected. So if I was trading these type of patterns, which I do trade the ABCD patterns for small caps, during the month of March, my max profit target would actually be 20%. Now, if we go down to where the data is actually inputted, you can see here where I have the entry of where to be buying and the exits where to be selling. And there's a couple of them that have a little bit of outlier moves, over 100%, well over 20%. And a lot of people would be like, well, how do I actually stay in those trades longer? With mechanical trading, the idea isn't to always be in the trade as long as you can. The idea is to be consistent. If you want to be a consistent trader, you want to have a consistent risk level per trade, a consistent profit target per trade, and there will be outliers where you're going to leave some money on the table. But over time, you'll actually see where it actually equals out. So in this particular month in March, there are some times where it barely reaches 20%. If you were anticipating a bigger move because maybe another ABCD pattern went up to 30% or so on, you may not actually either take a profit, or you may end up taking a profitable trade and turning it into a loser. Basically, what it comes down to is consistency. What is the objective that you want to achieve in the markets? If it's consistent income from the markets, you want to have consistent profit targets. And that's where the data comes from. Now, a lot of people say that because you're going to be leaving, if you're taking, for instance, on this particular trade right here, if you're taking 20% and it goes up to 78, you're leaving almost 40% of it on the table. And the thing is that you got to understand is you're not leaving any money on the table. Yes, the stock went higher than you anticipated, but you didn't leave any money on the table because you took what you knew was going to happen. You took the best part of the move that was statistical and probable from that particular pattern. Anything beyond that has a lower probability of it working out anyways. So why worry about that? A lot of the times also I've had some of the traders that I talk to, when they're seeing these outlier moves that's moving, well over 100% or well beyond what they're trying to target, they decide not to track them. I would actually encourage you to track them. The reason why you're doing that is there are going to be situations, especially in 2020 and 2021, where the average probabilities were actually much higher. And you wouldn't know if that was happening or not unless you tracked every single trade. And just having 2 or 3 high, numbers throughout the month, there's only 3 times of where the ABCD pattern reached over 100%. That's not going to really affect your data that much. Now, if you're looking at a small time frame, yeah, you may have a little bit of irregularities in the data, but over the time of the month, it'll level itself out, and you'll get those probabilities. And the great thing is with something like this, when it comes into a new month, what you want to be doing is using the past month's data to start the new month. That's what I actually do, is I use the previous month's data to start the new month. More often than not, from what I've seen, is when a new month comes around, for a certain amount of time, stocks react and act in a similar manner as it did the previous month. A day or two over the weekend, there's not going to be much of a change. If the change starts to occur when you're tracking for a new month, usually a week or 2 weeks into it, you'll start to see that slow shift in either direction, whether it's up or down. But at least for the first week, you'll actually be using the previous month's data. So that's it for this video. You can make data tracking as complex or as easy as you want to do. It doesn't have to be very complex. All you're looking for is basic data and information from that particular pattern. And if you like this content, subscribe to the channel. If you have any questions or anything like that regarding data tracking or mechanical trading or systematic trading, leave the comments below. I'll see if I can get to them in the future. Maybe do a video of answering each question. And that's it. Hope you guys enjoyed it, and we'll see you next time.